This is Smart Investing with Michael J. Wren.
You got into this business because you're funny and you're weird and you're socially retarded, and you also got to do it because it pays well.
Securities and advisory service offered through KMS Financial Services.
This is Smart Investing with Michael J. Wren.
You're cold, you're distant, you're emotionally unavailable, but you're always punctual.
And Michael's co-host, Chris Martin.
You go forth and be crazy. I think I could manage that.
For I have the pride, the privilege, nay, the pleasure of introducing to you the one, the only.
This is Smart Investing with Michael J. Wren.
You should all leave, and when this thing's over, I'll meet you at the nearest bar.
Hello, everybody. You're back with the second hour of Smart Investing here live on News Talk 590 KQNT AM. This second hour, we're only live on News Talk 590. We are not on for 2 hours on KPTQ, just the first hour. So that's the difference. Telephone number here to the studio is 509-241-5900. Please call the questions that you have on our topics or some sort of an issue that you may have as far as investing. Again, 509-241-5900. You can find us on the web at smartinvestingshow.com. You can stream us live on the internet off of newstalk590.com. That website has a button that's pretty easy to see that says listen live, and you're right there.
We also have a link on our website, smartinvestingshow.com. We have a link to the Listen Live setup. So
wow.
We have everything on our website, I'm just saying.
That's very, very cool. And this is the investment show where we try to take the topic of investing, make it easier to understand, get you good information on each and every show, and make it somewhat entertaining so it's a little bit lighthearted and easy to listen to. So the first hour of the show was me kind of getting a little bit, maybe off to a slow start, maybe off to a quick one. Comparing risky investments to risk-free ones. Really, in this day and age, there is no comparison. Everybody is completely too scared and too negative about investing in companies. And that is making the buying opportunity of my lifetime, probably of your lifetime too.
Well, because we have to trust people, and there's been a lot of people on the news that are not trustworthy.
Yeah, but you're talking trusting a basket of companies, and I'm talking truly of a small basket of individual companies. I'm not necessarily talking about a mutual fund. I'm going to get in the weaknesses of that very, very quickly. So in review, your risk-free rate of return in now day and age is truly under 3%. We can meet that risk-free rate of return just with dividends from what are called risky investments available to us. The risky investments also have two other places that they can increase their earnings and therefore increase their earning capability to our hip pocket. So dividends alone is going to equal the risk-free rate of return, or beat it in a lot of cases. Then we have the company just doing more business each and every year. That's going to help. Then we have the company having to raise its prices when inflation occurs. Let's say if the price of rubber goes up, a tire manufacturer just simply raises the cost to cover their costs. That protects you from inflation. Everybody thinks that, oh, this inflation that's coming down the pike, you got to own gold to protect yourself from it. That is the wrong answer, everybody, because you didn't think it through far enough. You only did the Dungeons and Dragons Armageddon thinking. You didn't actually think it clear through for the 21st century, okay? So, if that's the case, except for money that we need for safety, and to make you feel good about having cash money in the bank, earning nothing, anything else, I would be invested in individual companies that pay good dividends because the valuations are so skewed. The risk-free rate of return is so low that getting that risk-free rate of return, even from the most boring companies available to us, is easy. What can be more boring than Campbell's soup? That's not a solicitation to buy or sell, but the dividend on Campbell's soup is going to equal the 30-year Treasury bond. Well, that sounds pretty good. Are people addicted to smoking, Chris? Yes or no?
Just a tad.
Okay. The dividends from all of the cigarette manufacturers by far exceed the 30-year Treasury bond. You don't have to agree with it. You just have to know that that's a pretty solid business.
Yeah, if you ever drop your daughter off, especially mine, by the high school, you'll notice that there's future generations that are going to make you rich. So.
Unfortunately, yes.
Unfortunately.
We're not talking about health. We're not talking about right or wrong in culture. We're talking about smart investing. Okay? So, this is a wonderful time for me because the risk-free rate of return being so low and the price that I have to pay for future earnings and dividends from these wonderful companies that I love talking about is so low that there is no reason in the world not to do it. The only reason would be if somebody doesn't understand what's happening. So I just don't leave it at that and say, okay, let's buy this XYZ individual company. I look at relative valuation. What's that mean? It means that if I'm looking at a drug company, I look at its relative valuation to the other drug companies out there, its relative earnings power, and its dividend. So in a group of peers, I look at that company, whether it's an oil company, an automotive one, drug company, you get it. Sometimes there isn't another place to look if you're Boeing. Who else makes airplanes like them? No one. So Airbus, but I mean, come on. So, I mean, you don't have, some industries don't have that many companies in them. So that's one way. Here's a downfall of relative value. If you were looking at an internet company in 1999, they were all pretty relatively valued the same, and they were all extraordinarily overvalued, and they all came crashing down. Look at real estate. Real estate was, the whole global thing was valuated in a certain way, and it's come down drastically. So that's one of the weaknesses of relative valuation that I know, that I'm aware of, because I'm not a salesperson selling you funds and annuities. I'm what you call an investor. I also look at acquisition value. The price that another company may want to buy this company that I'm looking at, okay? What is the acquisition value? What's this earning stream worth? That's where we get into present value, future value calculations, and you've seen it time and time again. If you've got a big company selling widgets and this smaller company sells widgets too, sometimes the big company wants to buy the smaller one, then fire all of the people at the smaller company, but keep their customers. Okay? That happens, unfortunately, but I'm just telling you how it works. Liquidation value. That liquidation value is if the company went into bankruptcy. What is stuff worth? A lot of times when I'm looking at that, I look at book value. What at least what are the assets, the property, plant, equipment, cash, brand names, all those added together on their balance sheet? What is all that worth? What's the tangible value of the company? The stuff that you can actually go out and see and touch and sell, the bank accounts that you could raid, and the brand name that you could sell for very little amount, maybe like RCA, or a huge amount like Coca-Cola. You know, trademarks are a big deal. So book value I'll look at. And then you look at the sum of the parts. Some companies, this is how Warren Buffett bought Burlington Northern Santa Fe, not only was he buying a railroad company, but he was buying a huge cache of coal in Montana. Kind of odd thing, okay? But you've got to look at everything that the company owns. So when you look at, that's what I'm looking at, and that's what mutual fund managers are trying to look at when they invest in individual companies. I'm also trying to figure out 5 or 10 years of earnings, which is almost impossible to do. So I try to normalize the earnings and really take a negative approach. But still, I have to take a realistic approach in the fact that prices for these individual companies are low compared to what they earn, compared to all these valuation techniques that I just described to you. So this first segment was me telling you that in 6 different ways from next Tuesday, I can prove to you mathematically and in sound investment strategies why these so-called risky investments are insane good deals compared to risk-free investments right now, if you have the emotional capability to be an investor. When we come back, I'm going to attack the weaknesses of mutual funds. I'm going to bring up what the hell is a wrap account, and I'm also going to take a pretty good global thermonuclear device and drop it on Edward Jones. So anyway,
the views expressed here on Smart Investing.
Right, and it's I got some intel from my industry this week, and I'm going to promptly give it to the public so you can see what's happening.
You're going to be your own little wiki link, aren't you?
Yeah. Anyway, I'm Mike Wren. This is the show Smart Investing. You're listening live at News Talk 590 KQNT AM. Telephone number here to the studio is 509-241-5900. You can find us on the web at smartinvestingshow.com. You can also listen live. We'll be right back.
Any opinions expressed herein are given in good faith and are subject to change without notice and are correct only on the stated date of issue. Past performance is not always indicative of future results. This material is not intended as an offer or solicitation for the purchase or sale of any security or other financial instrument. Security, financial instruments, or strategies mentioned may not be suitable for all investors. Prices, values, or income from any investment mentioned in this report may fall against the interest of the investor, and the investor may get back less than the amount invested. This material does not take into account your particular investment objectives, financial situation, or needs, and is not intended as a recommendation of particular securities, financial instruments, or strategies to you. Before acting on any recommendation on this material, you should consider whether it is suitable for your particular circumstances, and if necessary, seek professional advice.
You're listening to Smart Investing with Mike Rand.
Isn't he, crazy?
The important thing to remember is he was never charged with a crime. It's not illegal to fall asleep on your neighbor's roof.
This is Smart Investing with Michael J. Rand and Michael's co-host, Chris Martin.
If any of you need anything at all, too bad. Deal with your problems yourselves like adults.
That's pretty funny.
That could have came straight from my dad.
Yeah. Well, I'm Mike Rand. This is the show Smart Investing. Thanks for listening. So, I just have spent an hour and 20 minutes telling you why I think what are so-called risky investments in the stock market are such a good deal right now, okay? Here's the other thing, is that if they're such a good deal, let's own some. My whole industry likes to sell you mutual funds, okay? We're going to start with mutual funds, then we're going to get into wrap accounts, then I'll tell you what a large national broker-dealer's doing. But firstly, mutual funds. They're a basket of investments that are bought and sold by the mutual fund manager. When we're talking about that basket of investments being stocks, those are typically called, guess what? Stock mutual funds. Okay, I'm starting out slow. We're going to get quick, real quick. So, stock mutual funds invest in stocks. Pretty easy to follow. Sometimes international, domestic, a combination of both, whatever. Stock mutual funds have been under pressure since the market downfall of 2008, and it's pretty easy to follow. If you're a mutual fund manager, we talked about it earlier in the first hour, you need money to manage. If you take your money away, that mutual fund manager has nothing to do, and there's no value added. So what happens in the year like 2008 and all up until recently, the stock mutual fund industry, and they won't tell you this, has been in what's called net redemption mode. In other words, more people have been panicking and pulling their money out of mutual funds than have been putting it in. What that does to a manager, it's, let's just say this manager has this basket of companies that the manager loves. If the manager isn't getting any new money in, that manager's unable to go out and buy more of these companies on sale, which is what they are right now. If you're truly a long-term investor, this is a low-price time where you can get good deals. Just like real estate is a low-price time where you can get good deals. Okay, doesn't mean that you're going to make money extraordinarily soon, but people can tell relative valuations usually, if they keep their head about them, that in the future there's money to be made. So darn it, this manager isn't getting any money to go buy things on sale. Well, that's a bummer. What's worse of a bummer? Well, what's worse of a bummer is that if this manager has to actually go out and sell some of these companies that they hold in their stock mutual fund just to create cash to send to the person panicking, called a redemption call, a redemption check. They have to send a redemption check to the person who wants all their money back because they think the world's ending. That creates kind of a self-fulfilling prophecy, driving the performance of that mutual fund even lower. So not only do you have to have a good manager at the helm that knows what to do, you have to have a mutual fund that's actually taking in money in order for this all to work. If the mutual fund is doing nothing but bleeding money, you can see where that might hinder the progress, so to speak. Well, that's all my industry talks about, isn't it? Mutual funds, you've got 3 of them. How about a 4th one? It's my favorite. If you've got 10 mutual funds, how about 2 more? Because I really like these. I think they'll dovetail well into whatever you have. Well, wow. That kind of starts falling apart if there's so many net redemptions going on in the mutual fund industry that the manager doesn't have anything to do except sell and hold on tight while the net asset value goes down. Not a pretty picture. There is a way to avoid that, or to combat that going on, is that you invest in a stock-oriented mutual fund that has such high dividends, or has a few bonds in there that pay such high dividends, that cash flow that's created is coming into the fund not from the general public investing, but from its own securities. So it's kind of creating its own weather, creating its own cash coming in. So there's cash coming in to pay people that are panicking, and usually with those type of funds, there's enough cash left over that the manager can go shopping. They can go buy stuff on sale. That's why, if you've noticed, your balanced funds and stuff like that have typically been outperforming the more aggressive ones, because they've been getting money to do something with, and the more aggressive funds have not been getting any new money at all. I don't think you've probably heard this from your Edward Jones rep or your Merrill Lynch rep recently, have you? No, because they're worried about selling you something. Okay? So that whole thing that they propose to you breaks down if the mutual fund manager isn't getting any money. At some point in time, it'll right itself, but last time I checked, people didn't really realize when I told them that they'd be making money at some point in time. They wanted a little bit more of a defined area, a little bit more of a defined target, rather than at some point in time.
Somewhere out there.
Yeah. In other words, I don't want to base my whole investment prowess on when the general population of the cattle in the United States are all of a sudden going to turn positive and start putting money in their 401ks again. Lord only knows, that's anybody's guess. It'll happen one of these days, but probably after half the good recovery's already happened. So, that's the weakness of the mutual fund industry. They need cash flow. They ain't getting any if they're in the stock funds. I know I'm using the word ain't, it's on purpose. So, how about a basket of those funds? How about if those funds have a weakness, how about more of those types of funds? That's what a wrap account is. Let me digress for you. You can understand the concept of one mutual fund, and I'm sure you can understand the concepts of mutual funds that might deal in different asset classes, like a mutual fund that deals in bonds, a mutual fund that deals in stocks, a mutual fund that deals in cash would be called a money market, a mutual fund that deals in bonds and stocks together, fish and fowl, called a balance fund. How about a mutual fund that deals in international stocks, a mutual fund that deals in international bonds, a mutual fund that deals in small companies, domestically and or internationally, a mutual fund that deals in medium-sized companies, a fund that deals in large ones, maybe large international companies. Let's say a fund that deals just with companies that participate in the pharmaceutical industry or the energy industry. Do you see where I'm going with this, Chris?
Yeah.
Okay. People can understand the different nuances of what these different funds are supposed to do. Supposed to do is the key term. My industry likes to tell you that you should have quite a few of these different funds that represent these different asset classes. And when you smush all this together, your what's called risk-free rate of return is going to be okay. Well, when a significant portion of all these funds aren't taking in any money, doesn't mean that the asset class is bad, means that the investment product itself is flawed. So my competitors don't understand the weaknesses of the investment products that they deal in. I do. Do I still deal in mutual funds? Of course. But I know the weaknesses. So I'm purposely underweighting right now even funds that I love that have good 50-year track records. I know in the short term are still going to be under pressure from this cash flow situation that the whole industry is in. Then you have to take a look at, well, wow, if this person is telling me that this portfolio of funds is good, but Mike is telling me, well, some of these funds are kind of weak because they're not getting any cash flow. What's the difference? Well, the difference is a salesperson versus an investor. I want to try, at least do my best to try to make sure that my clients make some form of money. I'm not looking at it from, oh, this portfolio looks pretty. I don't care if it looks pretty. I just want it to work. Okay? I also don't want it to be on purpose complicated or sophisticated. If I can do anything, I want it to be the simplest solution possible. And I think there is a term in science called Occam's razor, something like that, where the simplest excuse is usually, or the simplest reason is usually the most correct one. That's what I try to do in the investment world. I do not try to make things on purpose complicated. That's what I'm going to talk about after this next break, is what a wrap account is. A wrap account is a group of mutual funds, typically, that is sold to you in terms of modeling and in terms of saying, okay, Chris, you to me look like this type of an investor, so my company is telling me that for an investor of your type, I should use model 1.5, which gives us this basket of mutual funds.
Like a menu.
Right. The menu's flawed, and guess what? The menu's expensive, and I'll tell you why when we get right back. I'm Mike Wren. This is the show Smart Investing. You're listening live on News Talk 590 KQNT AM. Telephone number here to the studio is 509-241-5900. We'll be right back.
This is Smart Investing with Mike Wren.
He has way too much confidence. Nobody knows him, and nobody should.